Okay, today's business video is about quality of earnings reports, otherwise known as Q of E reports. This is becoming a huge topic in small business acquisitions. I have been a business broker for many years and done dozens of transactions. Tens of millions of dollars of enterprise value changed hands, and I had literally never heard of a quality of earnings report until, I don't know, 5 years into my 10-year journey as a business broker is when I first started hearing it. And now you can't avoid it. Everybody's talking about Q of E, quality of earnings reports. This video is going to say what is a quality of earnings report and why do brokers seem to hate them. So we're gonna tackle this topic, and I just want to share a little mini rant about it and talk about a broker's perspective on the Q of E report. Okay, so I asked on social media this morning, I said, pretend I'm a newbie and explain what a Q of E report is in an easy to understand sentence or short paragraph. I want to give you some of the variety of answers I got. Sam Jones, I love his answer. He says a quality of earnings report is a financial analysis tool that poo-poos all over the broker's adjustments to earnings and pee-pees all over the small business owner's accounting methods. Sam, that is a wonderful definition. I had a good chuckle at that one, but it kind of feels like that's what it is sometimes. Craig House, CPA, he has a better, more serious answer. He says sellers provide a picture of their business financial health that may or may not be accurate. A quality of earnings report is prepared by a financial expert to give the buyer comfort that the numbers provided are accurate and reliable for them to make a good decision. I really like that definition, Craig. Appreciate that. Jeff says Q of E equals BS detector for the seller's P&L. Before spending the money, try reconciling the P&L with the bank statements. If they're wildly divergent and the seller doesn't have a good explanation, you just saved a lot of money. Move on. I think he makes a good point. Like, you might not need to spend the money on a quality of earnings report if you could do some of your own initial look over the financials and say, yeah, we're not even close, and throw it out before you get in there. Grant, I like how he says it. He's an SMB investor, and Grant Hensel says it's rebuilding the business's financials from the ground up using the only true source of truth, the bank statements, to see if that matches what's in QuickBooks. I really like that, Grant. Thank you for sharing that one. Zachary Jensen, he says a Q of E provides them. A Q of E proves the money you thought you were going to make is there and highlights any discrepancies. I think that's a good one. Ryan McDonald says a quality of earnings report is a financial analysis that digs into a company's earnings to show how reliable and sustainable they are, helping buyers or investors understand the true financial health of the business before making decisions. Another person just says, they make how much? Prove it. I think that's a good way to sum it up. So, got so many answers all across the board. Appreciate those answers, guys, that chimed in on X today. Quality of earnings reports, I just want to say, I think a lot of the debate over their validity and the necessity of them comes from a difference between lower middle market, which I would define as like $5 to $50 million sized business transactions, versus main street deals, which is kind of the up to $1 million or $2 million transactions. From 0 to $1 million, 0 to $2 million, that's clearly main street, small mom and pop businesses. But then there's like this space in between, the $1 to $5 million deals, where it's kind of like, we don't know if that's lower middle market or if that's premium main street, but that's where I like to play. Like, we do lots of deals in that $1 to $5 million range. And what I've observed over the years is this, okay? There's a lot of business brokers that are main street guys and gals that have done hundreds of transactions, and they never get quality of earnings reports because quality of earnings reports are often expensive. Like, it's not uncommon for people to spend 10, 20, 30, 40, 50,000 or more on bigger complicated deals on an expensive quality of earnings report. And someone that's buying a $250,000 tanning salon is not going to get one of those. They're just going to look at the business's QuickBooks. They're going to look at the credit card statements. They're going to run it by their CPA. They're going to do what's called due diligence, but they don't hire some firm to do a fancy, huge report and spend tens of thousands of dollars to do quality of earnings. And it just doesn't happen on those really small deals. And so you have all these business brokers that have done lots and lots of transactions. They never have quality of earnings reports on them. And then you have people all of a sudden showing up that are saying, I'm going to demand a quality of earnings report before we move forward and close this deal. And it gives a really bad impression, because I think a lot of the people that are demanding, they must do a quality of earnings report between letter of intent and closing, they're coming from a few different sources. And one of the big sources is the MBA programs that are teaching ETA, entrepreneurship through acquisition. And what I think is happening is, I think a lot of the instructors and gurus and experts out of Harvard and Stanford that are kind of set the standard and are teaching about, they started with traditional search models that are buying lower middle market deals, $5 to $50 million deals, and alumni from those schools are becoming investors for those MBA graduates and investing in their deals. And these are multi-million-dollar transactions with major banks involved, major investors involved. And on those $5 to $50 million deals, a quality of earnings report is just a thing everyone does. It's just like a normal thing. And anyone that's an M&A advisor that deals in that space, they're not afraid of quality of earnings. It's just like a thing that always happens. But those deals have typically, knock on wood, they have like more sophisticated, better done financials, and they sail through those pretty easily a lot of times. It's not that big of a deal. But on Main Street, like that $250,000 tanning salon I was talking about, they have terrible financials, they have terrible accounting practices. The quality of earnings providers are going to overcharge and beat the crap out of their financials, and a scared buyer that's leaning on a quality of earnings report and says, I'm going to buy this, but only if this quality of earnings provider says it's a good deal will I close on this deal. Brokers are like, screw that. We don't even want you as a buyer, because I'm just going to get a normal buyer in here that has some money and that knows what's important, what's not important, that can close on this deal. It's not going to waste my time. It's not going to bring some egghead firm in here to beat up my little tanning salon's financials with an overpriced, stupid report that's just going to make you try to change the deal at the very end or walk away from the deal after wasting all of our time. And then the seller's going to be mad at me and is going to fire me. And so there's a clash of cultures here. There's a clash between the Main Street business advisors, the business brokers that have done lots of little deals, can't spell quality of earnings. They just know street smart, due diligence, what matters, what doesn't matter, versus the more, I would say, sophisticated yet naive crew that's coming in from academia and is taking a middle market playbook and bringing that playbook to the streets of Main Street, and that's where this battle is playing out. And so what I think is happening is, I think you have business brokers that are getting into that $1 to $5 million deal range. And their experience is typically on six-figure deals where they've done lots and lots of reps, and they typically never have quality of earnings reports. And they start representing a $2 million, $3 million deal. And guys, $2-3 million bucks is real money. We're starting to talk real money here, right? And so these business brokers like these bigger deals. But, the buyers, the competition for the $5 to $50 million deals is so steep that a lot of the buyers, the sophisticated buyers, are like, you know what? I don't need as many investors. I'm not going to try to take down a $20 million deal. You know what I'm going to do? I'm just going to take it down a $2 million deal by myself or with one investor. And those are called a self-funded searcher. It's a little different than the traditional search model. And those self-funded searchers kind of got trained on that middle market traditional path that includes an expensive, detailed, thorough quality of earnings report. And all of a sudden they butt heads with this street smart business broker that's closed hundreds of deals. And this broker thinks this overly educated bonehead that wants to do a $50,000 quality of earnings reports on a $2 million deal is being silly, because I've done hundreds of deals and we never use quality of earnings. What are you talking about? You're a big idiot. You're just scared to do this deal. You're just gonna try to do that quality of earnings report so that you can retrade me later. That's the broker's attitude. But then the buyer's attitude is this broker is a complete idiot. This broker thinks I'm going to put my life savings, sign up for $2 million of debt and just going to take their word for it. These financials provided by the broker and the seller. Yeah, right. Like, I am going to spend the money. I'm going to spend the time before I put 7 figures on the line here. And this broker is a complete idiot if he thinks like anybody, myself included, is not going to do a quality of earnings report. So like, that's the battle. Like, that's the battle. It goes out on LinkedIn, on Twitter all the time. The two sides arguing about this both make some valid points. So what I want to say is, if you're a buyer and you're going to a broker that's a Main Street broker, they've done lots of small deals, just say you're going to do due diligence and do a lightweight, just grab a CPA, verify what you need to verify, and you can call it a quality of earnings report or not, but definitely check what you need to check to feel comfortable and to feel like you verified what you need to verify. You've done your due diligence. You can close with confidence. Do it. If you're a broker, like, guys, millions of dollars is real money. You know what? $500,000 is real money. Like, we can't get bent over the axle about some bad experiences we've had with inexperienced buyers wanting to do quality of earnings reports. Quality of earnings is becoming more mainstream, and brokers have to adjust to that reality. We have to realize, like, yeah, some of the best buyers that are real serious and they have real money and they're going to get the deal done, they're going to demand a third party look it over. So we've got to start building a list of kind of a naughty list and a nice list of, I believe there's the quality of earnings providers out there there's some really bad actors. I think there's some really bad ones that just see a lucrative opportunity to charge big bucks to naive buyers to think that my quality of earnings report is going to keep you perfectly safe. And I'm taking this godlike stance of, I'll bless your deal or not bless your deal. And guys, I think we got to figure out as brokers, like, who are the ones that are actually there to protect the buyers, but find the solutions, point out the discrepancies, but be deal makers. You know, like, know what hill to die on or not to die on. Like, they can't expect the little business to be GAAP compliant and to have like reviewed or audited financials every year, or to have done things perfectly. The typical small business, like, they do some things wrong. You know, like, they put some things on the balance sheet that should be on the P&L and vice versa. The tax returns won't match the P&Ls perfectly. They'll do one cash and one accrual and stuff like that. And you have to be able to like sort that out and figure it out. But it doesn't mean it's a bad business. It doesn't mean anybody's lying to you. It just means they don't have like GAAP compliant accounting. That's exactly what these fancy firms want to see. Like, they expect in a middle market deal. That just doesn't happen on Main Street. You can't expect that on Main Street. So if you do have a quality of earnings provider, you need to figure out who the best ones are that kind of get it. They get Main Street, and they get like, hey, I know it's not going to be perfect. I know there's going to be these common things, but we need to verify the big things and make sure that like this buyer's not just holding the bag here on like something that's totally off. But we're not going to like pick this thing apart and mock this poor seller that's just been doing things the way they've always done it on Main Street, and that everybody else does it on Main Street, because like, that is not productive. So I hope this video helps. Like, a quality of earnings report is just that. It's a report. It's a third party looking over the tax returns, the profit and loss statements, and the bank statements, and they're helping you with your due diligence, and they're helping analyze like what's been presented by the seller and the broker, and make sure there is actually there. And in and of itself, that's fine. My beef is when people buy it thinking that either this is the quality of earnings provider is like God, the end all be all of what's a good deal, what's it really worth. I think the quality of earnings provider is just there to educate, point out discrepancies, but they shouldn't be saying, I would do this deal if I were you. I wouldn't do this deal if I were you. I think this is overpriced. I think this is underpriced. I think you should change this. I think you should change that. Like, they shouldn't play broker. They shouldn't play valuator. They really shouldn't. Like, they should just find if there's anything that was presented that's actually different than what they see when they go to the source data, and then shut their freaking mouths. Like, that's what they should be doing. But if there's ones that are trying to insert the deal, or if they're selling their quality of earnings report as a weapon that you're going to use to retrade the deal, like, those are bad actors that we don't want in this space. I don't want one. I don't want a quality of earnings report provider that takes that attitude, the adversarial attitude that says, yeah, you buy my report for 50 grand. This is what their pitch to the buyer is. Buy my report for 50 grand. You're going to be able to get, at least $250,000 off the price of this business after I beat the crap out of them. That's basically like the stance they say in a little more fancier words than that in their pitch to you on their websites and on their social media. Like, you don't want that guy. You just want one that educates, presents, and gets out of the way. And brokers, you got to be comfortable with that. And yes, you can push back if they're bringing in a clearly bad actor that is going to follow that playbook and just use the quality of earnings as a weapon to try to retrade you and gotcha you and put expectations, middle market expectations on Main Street that don't belong. That's not what you want. And so I think we're all navigating this messy middle space between Main Street and lower middle market. I think we need to extend some grace to the buyer that legitimately needs and wants a quality of earnings report. And I think we need to extend some grace and deference to the broker that's done lots of deals without them and knows how to cut through the BS and say, guys, let's be common sense about diligence here. Just tell us what you need. We'll get it for you. But we don't need to just outsource the decision and the negotiation to this third party that's got no real skin in the game here. We got to understand each other. We got to meet each other in the middle. And if we extend patience and grace, understand each other's perspective, we will be able to find the compromise. We'll be able to make a healthy deal somewhere in the middle here, but don't dig in. Because if you're a broker, don't dig in and be like, yeah, quality of earnings are just crap. Like that only these MBA buyers have never done a deal before and are just going to waste your time. That's all it is. Like, you can't take that extreme stance. And you can't, on the other side, take the extreme stance of like, yeah, it's a no-brainer. It has to be done every time. Have to use the best provider. You have to retrade after it. Like, that's not the truth either. Like, the good deals are going to get done when both sides understand each other, figure out what's important, what's not important, communicate with transparency, and don't be an adversary. Like, work with the other side. Like, be excited about buying that business. And your stance as a buyer should just be like, guys, I am super excited about this. I believe everything that you've presented. I am just verifying it because that's wise to do. But, as long as, I'm not expecting it to be perfect. I'm not going to nitpick every little thing. But as long as we're like pretty close to what we have here, like, we got a deal. We're going to get this thing done and we're going to get it done quick. That's what we want to hear. And don't get wrapped around the axle or let an egghead third party take over your deal. That's all I want. Hopefully this sheds some light into the great quality of earnings debate that rages on in the premium Main Street, especially the $1 to $5 million deal space. That's where these major clash of the titans are happening right now. And should we do quality of earnings or should we not? It's really happening. The debate's happening right there. And there's not really a right answer or wrong answer. We just got to be patient with each other, understand each other, and we'll get good deals done together. Thanks, guys.